2022 has been a terrible year for most investors. Stocks are down, cryptos are down, bonds are down. Basically, everything is down except for the price of your chicken rice and interest rates, which are still going up. And now, we are in 2023. New year, new me. You would think that the worst is already over, right? Wrong. Because now, everyone is talking about a recession happening. Everyone except for one person. All jokes aside, even though the recession sounds super scary, it is actually one of those rare opportunities where if you do it correctly, it will be your once-in-a-lifetime chance of making tons of money, aka what big. So, in this video, I'll be sharing some tips on how you should invest in a 2023 recession, what to do, what not to do, and also where's the market bottom. Also, a huge thank you to Phillip CFD for sponsoring this video. But more on that later. Since World War II, recessions have happened every 6 years on average. So, recession is all just a part of a healthy economic cycle because it helps to cool the economy without loss-making companies and lift up the strong ones. So, recessions are actually not that scary, other than the fact that during recessions, millions of people will lose their jobs, the unemployment rate will rise, earnings will fall, and the markets will crash. But it's also true that once the market recovers, the recovery is usually fast and furious. And here lies your window of opportunity to build an insane amount of wealth, because here is where you get to buy stocks at a huge discount. But before you can enjoy the upside, you first need to go through this super painful period where you will see your portfolio go down and down, especially if your entire portfolio consists of only Tesla stocks. That's why it's super important to own good companies, because these are the companies that will go through a recession and not go bankrupt. Okay, the criteria of a good company is actually quite simple. First, it needs to be profitable, meaning it needs to be able to earn money. Second, it needs to have enough cash and low debt, so that it will not run out of money. For example, because Apple is holding a lot of cash and has very little debt, you know that even if they become unprofitable during this recession, they will easily survive it. Third, it needs to have a strong moat. For example, Amazon is dominating in the e-commerce space and cloud computing space. Google is dominating in the advertising space, and Microsoft is dominating in the computer OS space. These are the companies that will continue to do well during a recession. Last but not least, the company needs a strong management and a strong leader that can lead the company through bad times. But with that being said, if you are still blur and don't know how to choose stocks, or if you are just lazy, no worries. You can just invest in index funds and ETFs and still do well. For example, the S&P 500 has historically delivered around 10% return on average. Take note, it's average. I'm not saying you will get 10% return in 2023. Also, don't underestimate this 10% return. This 10% is beating average investors who are only getting 2% annualized return, and it's also beating 80% of professional fund managers over the long term. As to why index funds can do so well is because of one simple reason. They are always kicking out all the bad stocks while replacing them with good stocks. Given enough time, you'll get this amazing chart where it reflects the collective progress of the best companies. So, if you don't want to pick stocks, just go with index funds or ETFs and you will still do well. As to where you can buy stocks and index funds, you can check out Poems. Today's video is sponsored by Phillip CFD, one of Phillip Securities' business outfits. Besides investing in the usual stocks and index funds, Poems also lets you invest with both your CPF and SRS money, and at a very low fee. For the experts, Poems also offers sophisticated products like CFDs, warrants, unit trusts, forex, futures, and more. Right now, Poems is running a Chinese New Year promotion, where if you sign up now and opt for a CFD account, you'll get a $5 PlayMade drink voucher and enjoy $88 of CFD trade rebates. It only takes 3 simple steps to sign up. So easy. On top of that, if you opt into CFD trading, fund $1,000 and execute just one CFD trade, you will get 6 chances to win a 3-day, 2-night staycation at 115 Marina Sentosa Cove. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. Okay, the next step is to prepare some cash on the sidelines. I suggest holding at least 20% cash or more if you can. Yes, many people have said that cash is trash, you shouldn't hold cash. But surprisingly, even with a 9.1% inflation, cash is beating almost every other stocks out there. You bought Google, Apple, Tesla? Too bad those aunties and uncles who held cash last year are outperforming you now. Cash is extremely important, especially during a recession, because 1, this will be the year where you get to buy stocks at a huge discount. Even after falling so much, many analysts still believe that the market has not priced in a recession yet. So start building up your cash position so that when the time comes, you have enough bullets to take advantage of an even bigger sale. Also, this cash position is just for in case you touch wood, lose your job, so that you have enough money to eat and you won't end up having to sell your investments at a loss. That would be the worst position to be in. But here's a tip. Don't just hold your cash and do nothing with it. At the very least, keep it in high interest savings account to earn anywhere between 2 to 4% interest, or transfer it to brokers to earn some interest. For example, Poems is giving 2.6% on SGD and 3.07% on USD. The benefit of this method is that when the time comes, you can immediately invest the money without any delays. Now, you might be asking, why invest through a recession at all? If we know that the market will crash when a recession comes, why not just sell everything now, wait for the market to finish crashing, then only we start to invest? That way, we will avoid all the crashes while enjoying the upside. Short answer, we are not a fast call, and we don't know whether a recession will come or not. And even if it did, there's no way we can predict the market bottom. Even professional analysts couldn't agree on where the market bottom is. Some say it will fall to 3,002, some say 3,000, while the others say it will be even lower at 2,004. So if they can't even agree where the market bottom is, what makes you think that we can do it? And the danger of trying to time the market is that if you just miss a few best days in the market, you are going to end up with a super sad return or even start losing money. Because remember, our goal is to take advantage of all the discounts during this recession. And it would be bad if the market were to suddenly be like, whee, go back up, and we end up missing out on all the discounts. So the best thing to do is still to invest consistently no matter what. But with that being said, remember about the cash position that we talked about earlier? Here's where you can do a bit of market timing. Yes, I know that no one can predict the market bottom, but for the sake of this video, let's pretend that it's possible and let's see what the data says. First, in most cases, the market tends to go lower after the Fed pivots. And no, it's not because they are evil and wants to crash the market or anything. Or maybe they really are evil and want to crash the market. Anyway, the reason this happens is because the Fed usually pivots after achieving the target of cooling down the economy. And the side effect of the economy cooling down is that there will usually be a market crash. Right now, the market is expecting the Fed to start lowering rates around September. And if history was to play out again, we will only see a market bottom either in late 2023 or early 2024. So pay attention to when the Fed is going to pivot, because historically speaking, most rallies before a Fed pivot are usually just fake rallies. Second, pay attention to the S&P 500 PE ratio. Right now, even though the PE ratio has dropped from like 30 to 20 now, S&P 500 is still considered quite expensive, because historically, during recessions, the market tends to bottom anywhere around 12 to 13 PE ratio, which will mean that the S&P 500 still has a bit more downside to go. Third, as a guy pointed out on Twitter, the last phase of each bear market has always been the most painful period because that's when capitulation happens. There are two ways to measure pain. The first one is the VIX Fear Index. Analysts have found that historically, no bear market has ever bottomed without VIX reaching 45 or more. For example, during the 2000 dot-com bubble, 2008 Great Financial Crisis, and the 2020 pandemic crash. The second way to measure pain is by looking at the put-call ratio. In case you do not know, people will buy put when they are bearish and they will buy call when they are bullish. When put-call ratio spikes to 1.5 and above, that's when people get super bearish, and that could mean we are near the market bottom already. So if you want to try timing the market, these are just some of the signs to look out for. Okay, here are my thoughts. Personally, even though I'm super down on all my stocks, and even if the market could crash even more, I'm not that worried. Because 1, I know that this recession is just a temporary thing, and all my companies can survive it. 2, I get to buy stocks at a super cheap price. Then, when the market finally goes back up, as it always does, I will end up profiting a ton of money. Because stonks. Anyway, that's all for this video. Hopefully, it helps you out. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.